Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Marc Ostwald, who is a strategist at ADM. How are you today, Marc?
I'm very well, thank you.
Well, thank you very much for coming on the show. We're going to talk about, well, it's non-farm payroll Friday. We're in September already. What's your take on, well, what do you think the number will be, and are people looking at the headline this month, or hourly earnings, more importantly?
Well, the consensus basically looks for a slight deceleration to 180, private payrolls to be down 170. It is the case that people are probably looking at that ADP reading slightly stronger than people were expecting, 237. However, they'll take it with a pinch of salt because in the past 5 to 10 years, the ADP measure has overestimated the initial print that we get as opposed to the revised reading on non-farm payrolls by something in the region of 50 to 60,000. On an average basis, and therefore that leads you back to the same number you first thought of. That said, when I look at things like the consumer confidence labour differential, which is at its cyclical high and climbing very sharply, initial claims pretty much close to 43-year lows, there is still a risk that actually may come in slightly stronger than expected. However, as you say, I think the markets at the moment are fixated on what the Fed's going to do next. And as far as they're concerned, the only things which matter on that front are consumer price inflation and wage inflation. So the wage data is going to be the most important. The forecast for it is, I think, probably best described as agnostic. It's generally 0.2%. That would see the year-on-year rate tick up again from 2.5 to 2.6, but we're still not back at the level that we were back in February, which is 2.8. And on that basis, following on from the PCE deflators, which were both headline and core, 1.4 yesterday, markets are going to be still very skeptical about the Fed moving again this year. In fact, in pricing terms, the market's basically got one rate hike priced for the Fed for the next year. I think they'll prove to be wrong, but that is going to be the focus, along with the underemployment rate as opposed to the unemployment rate. Unemployment rate's forecast at 4.3, unchanged at the cyclical low. Underemployment rate been a little bit sticky of late. We ticked up from a cyclical low of 8.2 to 8.6 back in the June numbers, and we're stuck there at the moment. If you saw that come down, that would be an encouraging sign. And it seems fairly reasonable to expect it to carry on going down towards the previous cyclical low, which is 7.9. So we're not that far away from it. And once you're down below 8, then you are looking at a labour market which is actually very, very tight. So the only constraint in terms of market reaction today, obviously, is the fact that we've got the Labour Day holiday on Monday. And indeed, it is the start of the Hajj. So it's Eid al-Adha in a lot of Middle Eastern and Asian countries, which will also withdraw some liquidity. So barring a big surprise, the reaction may be rather muted until we get to next week.